Okay, the news is out. So over the past couple of months, I haven't been immune to the crazy turbulence that we've been seeing in the stock market. In fact, far from it. As it stands right now, there are multiple positions in my portfolio that are each down thousands of dollars. And yeah, it feels like crap. Shocker. In total, it seems crazy to say, but I'm down around $35,000 across my stock and crypto portfolio from all-time portfolio highs. And at this point, keeping an eye on the market really just feels like waiting to see which stock or which company is going to be next on the chopping block to have its earnings make it sell off by 50% in a day. Like, what's new for tech stocks? But seriously, no matter what metrics or fundamentals investors want to look at right now to analyze positions, well, the level of volatility and uncertainty regarding the markets at the moment is seriously unparalleled in recent times, even honestly surpassing March 2020. In fact, overall market sentiment over the past 125-day moving average is in extreme fear territory, and with everything else that's going on in the world right now, I know a lot of investors have been thinking sort of the exact same thing as even myself right now, and that is, should I take my losses on the chin and just move on, or should I just continue staying invested, continue investing into the markets, and actually view this as an opportunity right now, like every past recession and crash, to get into the market for long-term appreciation? That is, if you are a long-term investor and you're not, a day trader that has open positions that you're expecting to swing trade in a couple of weeks. By the way, my name's Griffin, and this channel is all about helping you better your personal finances and your investing. So if you haven't already watched all my other videos about investing, real estate, stock market investing, etc., what are you doing? Make sure to add those to the queue and expand your knowledge. Okay, so realistically, $35,000 just evaporated in the markets. Obviously, that's a lot of money, and it was more than like half of my year's salary back when I used to work a job. So I'm not just sitting here saying it like it's nothing. Obviously, this is a tough situation to be in, and kind of even starts putting into question your financial decisions as well as your views on the market. But while I'm technically down $35,000 in my portfolio, well, it's important to put this into perspective and remind myself of the fact that this is $35,000 down from, portfolio highs, right? So also taking into account unrealized profits at the time from months and years of investing, not strictly just 35K down from my own capital injected into the portfolio.
Your account into a portfolio with your son, and it's gone!
Of course, though, like pretty much anyone else who's invested at all over the past 6 months outside of energy and utilities, well, I'm back holding a couple positions that are down pretty hard, like True Leaf Cannabis and PayPal. You could even say that returns in the cannabis sector have gone up in smoke. Wow, that was pretty bad. Had I put stop loss orders in place, or say sold out of my entire portfolio a couple of months back, then sure, I'd be sitting here right now $35,000 richer, but it is what it is.
That's the way she goes.
And that's not the nature of long-term investing, considering the fact that nothing's changed in terms of my portfolio construction, right? I still allocate the largest portion to low-cost broad market ETFs, as well as dividend stocks, and even tech stocks I do have strong conviction in for growth over the next couple of decades. I'm not preoccupied with what's going on in the short term, quarter to quarter, or even month to month, day to day, as it is right now in the stock market, it seems, right? I'm looking at you, Amazon. That was basically a long way of saying that I'm not down $35,000 of actual principal that I put into the portfolio myself, right? This is because I've been investing for years, even long before the March 2020 crash, and was consistently dollar cost averaging throughout that entire period anyways, not just going all in on 3 microcap stocks. Obviously, though, there's a lot more going on under the surface than just millions of retail investors getting spooked and exiting the market faster than Elon Musk buying up billion-dollar companies. So to get some more context as to whether or not consistently buying into the markets continues to make any sense at all right now, considering the fact that the broad market just continues selling off, well, we need to speak about how we even got here in the first place, and if we'll be seeing a longer-term recession, which could very well continue driving down prices in the market. Realistically, this goes back over 2 years now to the beginning of the pandemic, when interest rates got slashed down to zero, and the Federal Reserve started printing ungodly amounts of money to help prop up the economy and further stimulate economic growth when basically everything was forced to be shut down. And of course, if you paid any attention over the past 2 years, it totally worked, right? And the stock market took full advantage of millions of new retail investors pouring their stimulus checks into AMC and Robinhood stock. Jokes aside though, the S&P 500 did expand by over 100%, doubling investors' capital, and the Nasdaq Composite surged over 130%, both of which representing insane returns following such a rapid recession. We can thank thank big tech for that one. In addition to this, low interest rates over the past couple of years have now made it way cheaper to borrow money, further contributing to a housing crisis where lack of inventory and heightened demand have shot up prices and made the hopes of home ownership pretty bleak in the short to midterm for millions of people who are currently renting. Fast forward to today though, and yeah, we're now really feeling the effects of a balloon monetary supply and inflation that's just through the roof, which is now really impacting everyday consumer spending and also investor returns, as all the momentum and euphoria of the market over the past couple of years have completely left the chat. Couple that with major supply chain issues, China shutting down again, the oil crisis, and the war over in Ukraine, and we've got the perfect storm for markets shedding off the past 6 months worth of inflated returns. In addition to this, there's just so much pessimism in the market right now, specifically for certain industries, where this past earnings period was an absolute bloodbath, with most companies falling short of their earnings expectations, sliding them into 20, 30, 40% losses even. There's no denying the fact that many companies and their stock did end up with overly inflated valuations over the past year, definitely. But a lot of this rapid market movement is also caused by increased investor pessimism and overall investor emotion. For example, let's take a look at Amazon that I'm a shareholder in. I've said this multiple times on the channel and plan on continuing to be a shareholder for decades to come, right? They just saw the slowest growth in 20 years, which, yeah, on the surface seems absolutely terrible, but considering that they still saw 7% year-over-year growth, and this is compared to Q1 2021 in the height of lockdowns, where there was 44% year-over-year growth for that quarter. The company is still growing tremendously, especially considering its current size. My point is, bearish headlines and titles in parallel to everything else that's currently going on in the world and the economy have the markets extremely bearish, with retail investors fleeing the markets just as quickly as they entered them. Speaking of the economy, are we in a recession now or what? Well, first of all, for the stock market to be considered to be in a bear market, we'd have to see the broad market shed off 20% or more. So we're definitely in that trajectory for the S&P 500. What's pretty crazy to see though is that even though March 2020 may have actually felt worse, well, based on historic data, we've just entered the worst start of the year in the stock market for the S&P 500 since 1939. Across the board, sea of red, unless of course you're invested strictly in energy and utilities. But even though this might be somewhat surprising, the stock market isn't always on a one-to-one correlation and a clear reflection of the economy and what's actually going on, even though most of all these companies do make up a large portion of GDP. So let's talk about that. Recessions happen when economic growth ends up stalling and actually start declining. Now, I remember a year ago, economists were saying that this was expected to only start happening in around 2023. But like most projections lately, that has not been the case. In fact, for Q1 2022, the growth of the US economy has been negative 1.4%. That is not good. And a recession becomes official when we end up seeing 2 consecutive quarters of negative economic growth. So if Q2 2022 sees negative economic growth, we're going to be in a recession. And although of course we can't see in the future, well, things are sort of trending in that direction as there's planned to be more interest rate hikes over the coming quarters. In fact, the Fed literally just increased interest rates by 0.5% on May the 4th, which was the largest rate hike in over 20 years to tame the flaming inflation. Talk about transitory, right? Well, this is only the beginning of many, with quite a few more of these 50 basis point rate hike increases planned in the upcoming quarters. So the writing's kind of on the wall that we'll most likely continue seeing major turbulence in the markets as we're navigating through several rate hike increases. And what's unfortunately kind of interesting about this is that historically speaking, leading up to and following rate hikes, the markets tend to perform extremely poorly, with stabilization and full-on recovery months after the fact. Okay, so with all this data and information taken into account, none of this unfortunately is really great for us investors, but at least on a positive note, most of us are consumers, and so this should help tame rampant inflation, which has a direct impact on all of our living costs. So hopefully we won't be spending, $15 on strawberries by next year. Hopefully. And in regards to investing, this is honestly why I don't make that many market update videos anymore. Even though they get a lot of views, well, this is pretty much what we're seeing online exclusively right now, and all of this is pretty much just noise to really just get more traffic, right? I made a video speaking about this a couple of months back called something like the 2022 stock market crash, and since then, none of my views have changed on the topic. As boring as it might sound, and I'm like a broken record, for like 95% of retail investors, sticking to a long-term plan, dollar cost averaging, and utilizing low-cost broad market market ETFs to make up at least 50% of your portfolio is just something that makes sense and that is wise for, again, like 95% of retail investors if you're investing for the long term, which I sure hope you are. And it's really staying invested even during turbulent times like right now that make the largest returns over time. That being said, this really applies more to like the S&P 500 and broad market funds, right? Not necessarily individual stocks. Just because a stock had a certain price point at one given time, that may have been an inflated valuation. And so just assuming that it's going to go up to that price at some point is like an anchoring basis that really just doesn't make sense. Staying invested for the long term is something that really makes most sense when you're crafting a portfolio made up of blue chip stocks, quality dividend stocks, and yeah, those broad market ETFs. I've been saying this for years, even before and during the March 2020 crash, and now this is all coming full circle for a lot of new retail investors, that is, and I'm seeing a lot of the same emotions as in March 2020. But imagine where your portfolio would be right now if you hadn't taken advantage of the March 2020 crash. With all that in mind, just keep in mind that recessions aren't necessarily the same thing as bear markets that we see in the stock market. So although right now it's a very emotional time and fear is at an all-time high, really, or at least back at all-time highs in the stock market, well, seeing this as an opportunity is actually one of the main things that differentiates the wealthy from the middle class. I made a video a couple of months back speaking about really why the middle class is shrinking in North America and the rich continue getting richer. And based on all the research I was able to do, seriously, one of the number one factors was because the wealthy really focus on increasing income, but the most important is because they actually have disposable income and enough money from, a higher savings rate to pour into the markets when we're in recessions. This is the number one reason why over the past 3 recessions, really, the March 2020 recession, 2008, and also 2000, we saw the largest transfers of wealth and the rich just getting richer and richer and richer over time, is because they can actually take advantage of recessions like what we're probably going to be seeing over the next couple of quarters, and hopefully it doesn't extend years, but at this point no one really knows regardless of what they say. So I really hope you enjoyed today's video. If you did, make sure to smash the like button. And hey, by the way, also I decided to throw out my full stock market investing course over on Skillshare. The reason why I did that is because now it is completely free for anyone to watch on a 1-month free trial, and on that free trial you can also access every other class available on that platform, and after that it's actually really cheap, right? So this course really teaches you everything you need to know about the stock market, how to read quotes, how to read financial statements, what to look for, how to craft your own portfolio, understanding your risk tolerance, absolutely everything. It is free over on Skillshare on a 1-month free trial. So thanks a lot for watching. Also, make sure to check out down below, links in the description. You can get 5 free stocks with Moomoo and 3 free stocks with Wealthsimple Trade. So with that said, I will see you in the next one.